Hi everyone, Jupan here from Kaya Plus. So today I'll be sharing with you all a favorite metric of mine, which I personally use, where I screen out companies that are worth putting effort and time to further study. What is it you are talking about? Well, this is a method I call the 4M analysis. Basically, we're going to look into four criterias, 4Ms, and from here, it will determine whether the company is worth my time to actually study further or not. Are you ready? Let's go! So the first M that we're going to talk about would be the economic moat of a company. So a moat is basically a man-made lake surrounding a castle, and the bigger the moat, it makes it harder for enemies to actually attack the castle. So in real life situation, we are looking for companies that hold a superior advantage over its competitors. This advantage can be so big that competitors will find it very difficult to actually challenge or to disrupt the business of the company. Now the second M that we're going to look at is the management of a company. Now you might ask me, why is it so important to look at the management? Picture this scenario. If you're flying on a plane and something bad happens to the pilot and the co-pilot at the same time, would that be a scary situation to be in? Now the same goes for a listed company. A listed company needs to have qualified and well capable management team to actually handle the operations and the activities of a company. Only then management team can lead the company to scale greater heights and achieve higher performance, in the end benefiting the shareholders of the company. The third M is one of my favorite metrics. It is the profit margin of a company. So a profit margin analysis actually compares two companies by highlighting which company is actually producing a higher profit. And as investors like you and me, we would definitely choose to invest in companies with a higher margin or a higher profit, because at the end of the day, these profits could be eventually translated into a higher share price or a higher dividend payout. Last but not least is the fourth M, which is money. Now, a profitable company would eventually bring in more and more money into its bank account. And this would be the most interesting time to see how the management team utilize the cash generated from the company's businesses. Will the cash be actually used to grow the company bigger? Or will a portion of it be actually paid out as dividends to investors like you and me? Ultimately, it depends on which business model the company is actually in and on what is the size of the company. A small company would eventually require the cash to grow its businesses bigger and bigger, while big and mature company might be more generous when it comes to paying out more dividends based on the cash generated from their businesses. So it's really up to investors to look into how management team actually utilize the cash generated from the business to actually gauge and to make a decision on whether cash is well spent or invested into growing a company's growth and the shareholders' interests. So I hope you really enjoy the 4M methodologies that I'm sharing with you today. Personally, I use it a lot because it helps me to identify companies which has good economic moat and are being managed well by a group of talented management team. Now ultimately, it does ensure that the companies has a high profit margin, and that will eventually mean that more and more money is flowing into the company's bank account. So eventually, a combination of these 4M would mean that the company is actually a good investment opportunity for investors to look at. So I hope you really put the 4M methodologies into good use into finding your next investment idea. Till we meet again, see you soon. I'm Jupan from Kaya Plus. Bye bye.